Welcome back, ladies and gentlemen. Now, last week, all of us saw the Economic Budget 2022, and it sounded progressive and inclusive, isn't it? But it seemed to be a non-event because government has been working throughout and many structural reforms have been happening on an ongoing basis in any case. And budget announcement was just a step in that direction. Some may feel disappointed as budget really doesn't give any direct benefits to individuals or any community. But it must be remembered, it was an economic budget and not a social budget. And so rightfully, it addressed the economic aspects and thus thoughtfully allocated resources to creating more employment, better infrastructure, higher security. The essence of Budget 2022 was to create the foundation of a steadily growing economy which attracts private as well as foreign investments. As India's growth wheel begins to turn, ladies and gentlemen, let us understand from the economic thought leaders who are going to be a part of this session as to how they crystal gaze stock markets going ahead. So we have a very interesting topic for this discussion, which is the expected composition of various sector and businesses' weights in Nifty 500 as India progresses to a $5 trillion economy. And the panelists for this discussion are Mr. Prashant Khemka, Mr. Ramdev Agrawal, and Mr. Sunil Singhania. And ladies and gentlemen, Mr. Kamal Manocha is going to be moderating this session. Now, let me take a moment and introduce our panelists to you. Mr. Prashant Khemka is the founder and CIO of White Oak Capital Management. Prior to setting up White Oak Capital Management in June 2017, he spent 17 years at Goldman Sachs Asset Management and also for the global emerging markets. He has won several accolades as the CIO and lead PM of GS India Equity. And he and his fund, in fact, have won several awards. In addition to his long-standing India investing experience, he brings a unique perspective derived across developed and emerging market equities and has successfully managed US and global emerging market funds for leading institutions during the last 2 decades. Now, moving on to my next panelist, an awardee of Rashtriya Samman Patra by the Central Board of Direct Taxes, Mr. Ramdev Agrawal is the chairman of Motilal Oswal Financial Services Limited and the driving force behind the company's approach to investing. Mr. Agrawal has created the QGLP, which is Quality, Growth, Longevity, and Favorable Price Investment Process, and its buy right, sit tight investing philosophy. He has been authoring the annual Motilal Oswal Wealth Creation Study since its inception in 1996, an associate of Institute of Chartered Accountants of India and a member of the National Committee on Capital Markets of the Confederation of Indian Industry. He has also been featured on Wizards of Dalal Street on CNBC TV 18. Now, ladies and gentlemen, our next speaker is Mr. Sunil Singhania, the founder of Abacus Asset Management, an India-focused asset management company in 2018. And he has over 2 decades of experience in Indian equity. As ex-CIO at Reliance Mutual Fund, he oversaw around $11 billion of equity assets. Mr. Singhania was the first mutual fund manager in India whose fund NAV touched 1,000 rupees, deliver a 100x return since inception. And Mr. Singhania is the head of various associations, including the chairmanship of CFA Investment Committee. A very warm welcome to our esteemed panelists. And this session will be moderated by Mr. Kamal Manocha, the founder and CEO of PMS AIF World, India's trusted investment platform for high net worth investors to make well-informed investments in PMS and AIF investment products. Now, Mr. Manocha has honors in economics from the Hansraj College, Delhi University, MBA in finance from LBSIM, and carries more than a dozen investment certifications and holds a vast experience of almost 2 decades in the field of investments. He's an enthusiastic teammate with the aim and purpose of serving clients with the most knowledgeable approach to investing. Once again, a warm welcome to you, Mr. Manocha, taking from the previous session to this very significant one. It's now over to you.
Thanks, Aishwarya. It is my honor to actually moderate this panel with thought leaders. My first question to Ramdevji, I will quickly come to seeking now wisdom from these 3 thought leaders rather than spending too much time. The first question, Ramdevji, we have seen over last maybe 5 years that rich people are becoming all the more rich, poor are becoming all the more poor, and it is all the more true when it comes to businesses, in terms of domination. There are very few businesses which are dominating each sector. And that is where when we see, the composition of NSE 500, it is kind of concentrated on the top end. Now, when we have been kind of projecting that this decade we'll see India growing almost by 70% in terms of its GDP from 3 trillion to 5 trillion, how will that 2 trillion get dispersed? Will it again remain concentrated on the top end, or you see it getting kind of spread out? What are your views, Ramdevji, on this?
Good evening, friends. I think it'll be more of the same. Maybe it'll become worse because with the digital move, digital is not a very democratic what do you call, I would say, ecosystem. In digital, basically a lot of fragmentation of any business gets consolidated, and there are only one or two or three winners. So actually, digital produces gigantic size companies. If you look at the globally, what has happened in US in 20 years, look at Amazon, look at Facebook, look at Google. I mean, still they look to be young companies. So a $2 trillion or a $3 trillion like Microsoft. So the issue is that digital per se is very consolidating force in businesses. One, it reduces cost big time, and fundamentally, the question you are asking is whether the big will become. I mean, will there be more democratization of the wealth dispersion? And that's why I think China has in last 6-7 months they talk about common prosperity and things like that. I don't know how successful they will be, but basically you have hit the nail. That remains a concern, but I don't see right now whatever is happening that changing, because there is a move of the technology, that is a move of the markets, and it is a very, very consolidating. So I think it is going to be more of the same, and that too at a rapid pace.
Right. Shan, my question to you is that we have seen, financial services used to be the top sector in US many years ago. Today it is the fourth largest sector. IT is number one sector, followed by consumer discretionary, and then pharma, and then comes financial services. But in Indian context, financial services today is the leading sector with 30% weights, and in NSE 500 and 37% weights in Nifty 50. When Ramdevji is saying that we are going to see the trend continuing, what are your views? Will we see this changing, or it will remain like that?
Certainly. So I think some of the trends would continue, as Ramdevji has pointed out, and some new trends we would see that have played out elsewhere globally already. So in the US, if you see, the new age tech companies were non-existent 25 years ago, right? 25 to 30 years ago. Well, there were other tech companies which might be considered new age at the time. Or China, if you see, till 7-8 years ago, it was dominated completely by government-owned companies. Majority, 2/3 of the companies were government-owned in old economy, and the so-called new age was non-existent. Even in India, if you see 25 years ago, banking or financial sector barely existed because it was all government owned and not all were listed. And technology was also a very small sector. So just like over the last 2, 3, 4, or any time period, you have seen, and even before that, you talked about financials in the US, energy used to be the largest sector at one time, and now it's, single digits. So similarly, I think in India, the growth of various sectors would can be two ways. One is they do very well and perform extremely well, which is impossible to say which sectors will so outperform that they'll grow in their size. But what can be said with greater degree of certainty is that a lot more new issuances would come in this new age sector, as has happened elsewhere. And that new age sector would form, we think, somewhere around 20+% of the market capitalization and Nifty weight over the next 10 years, or let's say by the end of this decade.
Sure. Sunil, my question to you, your style of investing is identifying growth in value, because you are cognizant about value, and the new age sectors, the new age companies are highly, valued, highly priced companies. How do you see, in terms of composition of NSE 500 changing over a period of time in terms of dominance versus, in various sectors?
Hi. So, there are two aspects to it. One is basically the pool of profit. I think the pool of profit will take some more time before it changes dramatically. The other thing obviously is the pool of market cap. I think that is already changing. So you mentioned about banking. I think banking and technologies are becoming now integrated, or financials and technology are becoming integrated. Similarly, consumer and technology are becoming integrated. So even in the US, Amazon is considered to be a consumer company rather than a technology company, So I think there will be a lot of, I would say, commingling of technology along with various sectors. As far as investing is concerned, obviously, some of these companies have created huge wealth. At the same time, there are a lot of companies which need continuous capital to survive and to grow. And that is the reason we believe that these companies are apt for private equity investors rather than the listed market investors. Because if you are not able to raise money being a listed company because of variety of reasons, including temporary, slowdown in the markets and so on and so forth, you will have an issue where survival itself will become an issue. And that is the reason, our view is that if you are a public market investor, you have to follow the basic principles of investing, which is paying something which is more than going to be repaid to you by way of future profitability. So while accepting the fact that technology is here to stay, I think we will like to be conservative and focus even on technology companies which have a business model which is based on profit rather than just based on market cap.
Sure. Ramdevji, my question to you, we have seen in December and January an unusual correction where we have seen, growth businesses, some of the, highly, I would say, talked about businesses, especially in IT, have actually seen a fall. And even today we saw, some of those high quality names that have fallen. Maybe, those names were rising earlier because of COVID, and now market is kind of trying to signal that COVID is over and old economy businesses will take over. What is your view, in this regard? What is market trying to convey with kind of, showing fall in some of these high quality growth businesses?
So I think the high phenomena, particularly in digital companies, were at peak. I mean, what we saw 4-5 months back, and at the time of issuance, and then even bigger hype was there post issuance. So I think the hype cycle doesn't last very long. It is not more than 6 months to a year, maybe 1.5 years or something like that. So here, I think the hype is busted, and that's what is happening now. Things are coming to the ground, and so this is the best thing to happen actually. My sense is that maybe there is some more correction. Then what happens is what you have done over hype, it will also go, there will be over correction also, because now the theories will come where the people are talking about 2045, 2040 projections and all, and they will try to justify the valuation. Now people will not believe what has happened in last quarter. ऐसा भी मौका है. So that there will be over correction to that, but my sense is this is a category. Let me give one trend, which is the biggest trend for India. In 1995, IT was not there. I didn't know difference between software and hardware. I'm telling you frankly, I didn't know computer, but I didn't know what is software and hardware. And we had 2000 Y2K, and at that point of time, India's software exports in 95 was less than $1 billion. By 2001, it became 5 billion. Today, it is 170 billion. In 2001, 1% of the corporate profit was coming from IT. Today, it is 25%. So that's the mega trend which has happened in last 20-25 years. Every year, 1% gain, and again, it is gaining further. So what has happened in US, where IT is the biggest, in India, 7 years, IT will be the largest profit pool contributor and highest quality profit. There is no IT company which is in loss. I mean, you don't see, in every other sector, you find many guys in losses and all. Here, there is nobody in loss. Maybe they are making less profit. Somebody is making 5%, somebody is 15, somebody 20, but nobody is fundamentally in loss. Nobody is indebted. So basically, this is the biggest achievement of India, and this is the biggest mainstay of it. And now on the back of it, you are getting digital companies, which are zero today in terms of profit pool contribution. But my sense is in next 15-20 years, they will also do as big a contribution in terms of profit pool contribution. And maybe they might be called, they are not per se tech company. They are consumer tech, or then you have medical tech, then you have insurance tech, all that. So it's a mixture of, as Sunil said, it's a IT and businesses, real business, old business coming together and creating a big monolith out of there. The good thing about this IT business, this digital business, they can do multiple businesses. A perfume company can sell lipstick company can sell fashion company can sell something else, they can sell grocery, then they can do this thing payment also. That is possible once you have the consumer within your fold. So I think it's a very interesting time. What has happened in US and China will happen in India. Now, at what pace, how big it happens, that probably Prashant and Sunil, they might be having some more views. I think it will be worth listening to them.
Over to you, Prashant. I think, Ramdev ji have actually ended the conversation by asking a question to you.
No, I think Ramdev ji gave the very right example of IT services. And you can even probably add banking to that. So one export oriented, which is IT service, and banking, which both of them didn't exist really. Private sector banking I'm talking about, just 25, 27 years ago, and are the two largest profit pools and market cap segments. Number one being banking and number two being IT services. And very much going forward, when you see these two would continue to now organically grow their profit pool, because there are not a lot of large IT companies or private sector banking companies that are out there to get listed. So the Nifty index weights, how it transforms is one, when the profit pools of certain sectors grow much larger or their returns are much larger, combination of profit pool and multiples. And second is through new listings. So I think on the export side, IT, and possibly we'll see some manufacturing sector, either be it chemicals, some of the chemical companies that didn't exist even a decade ago or were not in the limelight or nobody knew about them, are now multi-billion-dollar companies. They would continue to grow their profit pools and their scope of business. And I think those are, while very tiny sectors compared to where they are today, they can be much larger. But amongst the larger sectors, IT services, financial services, and as we're talking, not probably right to call them new age tech companies, but more new age companies, which combine or leverage technology to do business in a very different way than what it has been done historically, and gain and create value going forward. Those would represent, I think, the third large segment besides IT services and financial services could be these new age companies.
Sunil, my question to you, taking cues from what Ramdev ji has mentioned and Prashant has mentioned, that today, in 2022, there is a kind of a macro risk in terms of inflation, increase in interest rates, and, kind of equilibrium on valuations, and hence market could see consolidation. So given this environment, is it important for investor to actually be cognizant about trying to find out right value, and then hence trying to kind of differentiate between mid cap, large cap, and small cap in terms of being at a right value, so that if at all we see an kind of adverse situation of market falling, he's kind of saved in that context.
So see, Kamal, what happens, when you are buying equity or buying shares of a company, you're technically becoming a partner in the company. To the extent of your shareholding, you're a partner in the company, and you would want to become a partner in a company where obviously, you are expecting future returns by way of profitability and therefore by way of dividends and so on and so forth. And I think it comes down to the same thing, whatever business you are in, ultimately you would want to get the returns out of it. So IT services or the new age tech companies or some other sectors get a higher PE multiple because the growth rates are higher. And some of the other businesses where the growth rates are lower, they tend to get a lower PE multiple. And similarly, companies which are more stable in their earning profile, they tend to get a higher PE multiple because of assurance or more certainty of profit. And cyclical sectors like steel and so on and so forth will get a lower PE multiple. But at some point of time, any company you invest in will have to start to deliver profits. And I think it again boils down to the same thing, whether it's a large cap, mid cap, small cap. What is your expectation of growth and what is your expectations of future profitability, and what are you paying for? So I think from our perspective, it is very simple. And I'm not saying that only PE is important. Obviously we are okay to pay a 40 PE multiple to a company which is growing at least 25-30%. But a company which is growing at 10% to pay 80-90 PE is not, I would say, a sane. The other thing is that with all this technology coming in, the traditional business models are at risk. And the risk is in this consumer facing businesses. It is not in the steel company or the paper company or the textile company. It is in the consumer facing businesses. Today, you don't need a big distribution. You could technically be just be on some platforms to sell your products for people or consumers to even know about your product. So I think more threat is going to be in this consumer facing businesses from technology rather than the traditional. And therefore, it makes more sense to be very cognizant of the value you're paying. Obviously, in a volatile market, the large caps are a little bit more stable. But obviously, in a growing economy, and we are investing in India because it's a growing economy, not because it's a matured economy. That's why the P multiple of Indian markets are higher than others because the growth rates is higher. In a growing economy, new sectors, new themes, smaller companies tend to grow faster. So our view would always be that if you are in to invest from a 4-5 years perspective, the broader markets will offer you a better opportunity. But please don't get carried away by the theme of the day or the fashion of the day and invest at whatever price. I always say that we invest in companies which make profit, where there is growth in profit and where the valuation justify the price you are paying for. We are not here to buy fashion, and we are not here to buy and make money because of greater fees theory.
Right, Sunil. So since you have to log out, I will ask next question to you first, and then my next question is that we have talked about top end of the sectors, like financial services, IT, consumer discretionary, right? Maybe pharma. But when you are doing value investing, I'm sure you will be focusing on the bottom end of the sectors also. What are your views in terms of new sectors? Like we saw specialty chemicals coming out as a sector from bottom, right? So there are sectors like media, textiles, and likewise, what are your views, in that regards over say next 5 years, if we have to see the future composition of NSE 500?
Kamal, as investors, we are open to investing in any market cap company and any sector. But we have to be cognizant of the fact that these deep cyclical sectors can be very volatile and they are dependent to a large extent, say for example, China. But having said that, the cumulative 10-year profit of the largest paint company in India is equal to the last 2 quarters profit of the largest steel company in India. Cumulatively, 10 years of net profit of the largest paint company, profit of the steel company, and the market cap are still like 1/3. The steel company trades at 1/3 the valuation of the paint company. So at some point of time, profitability do matter. If you are able to see those sector, the companies go through cycles, I think you will know that when no one is looking at them, when valuations become so cheap, it's the time to buy. And I always say this, that in the last 3 years, at least we have made more returns by investing in a steel company than our best performing digital company. And as I said, the threat from technology businesses, you can't make steel by technology, you can't make textile by technology. You will have to go the traditional method. And therefore, in a balanced portfolio, you should not be closed to the idea of investing across sectors. Having said that, I think what has happened, as you mentioned, specialty chemicals, for example, it was a small sector. And then something happened, it was China, it was maybe logistics cost or whatever, and companies did very, very well. Now, at the peak of the cycle, you can't give them 30, 40 P multiple because two things will happen. Those margins are not going to sustain, and these P multiples are not also going to sustain. So, we should not get carried away at the peak of the cycle to give them peak P multiples, which is a very difficult thing. And I think with experience, by losing a lot of money in various sectors, you'll learn that. And I think you have learned that. As far as new sectors are concerned, obviously we continue to be very optimistic on digital. If you are able to get it at a price, the current meltdown will hopefully give us an opportunity. We still continue to be quite positive on the financial sector because a lot of these financial services companies, particularly the good ones and the large ones, are transforming them into digital companies, and they will be there, and there is a regulatory sort of, protection for them also. And the third thing is, with India growing in terms of its wealth and in terms of its per capita income, disposable income, a lot of these Indian brands will do very, very well. And as I said, the distribution now is available to all and sundry. the acceptance of these brands is available to all and sundry. And I think that will again be one upcoming sector which we feel should do very well as we move forward.
Thank you, Sunil. Thank you so much. And you can, log out if you.
Sure. Yeah. Thanks a lot. And sorry to be a little early.
Ramdev, moving on to you, this is my, personal question to you. I see you as, a value investor as well, because throughout your maybe quality investing, obviously you have been cognizant about quality, that, when we have done value investing. Currently, in the current context, when we are talking about digitalization, platform businesses, IT companies, all these are kind of, not value businesses. These are quality growth businesses, but we don't see value in them. But at the same time, we see value in some of the old economy businesses like infrastructure or maybe, auto. But these are sectors which we don't see in any of the portfolios. What are your views? How will we see composition of NSE 500 actually changing over next 5 years, when maybe, we will see 1 and maybe 2 more trillions getting added in that context?
Yeah. See, what happens is whatever grows in profit pool, that becomes larger part of the profit pool and eventually larger part of the even market cap. You cannot not give that market cap. The multiples can be somewhat different, but if your profit pool is 25%, from 1% to 25%, even if the sector P is like below the index P, still, see, like right now, I think somehow the IT profit pool is higher than the market weight in the Nifty. So that can, I think it's about 13-14%. But there are so many companies which are there, and they are very small in market caps. Their profit pool is very large, and there are so many loss-making companies in other sectors. They depress the profits of the overall. So ये जो BSE 500 का जो आप composition की बात कर रहे हैं, we have to focus on. We don't know what the market will like, but I know one thing: if the profit pool is shifting, you have to see which side the profit pool is shifting, where profit is migrating. Say profit is say 5%, 6% of GDP. My GDP is growing at 13%. So today my GDP is at 250 lakh crores. Of that 6%, say right now it is about 5% of the profit is of the GDP is the total corporate profit pool. So if it is 5%, we are talking about 11-12 lakh crores total corporate profits. Okay. Now that is growing at about 12-13%. If the corporate profit to GDP ratio doesn't go down, and if it goes up to about 16-17, then we are talking about 15-17%. Now within that, which is the segment which is actually dominating for some reason or other, our wish is one thing, but which businesses are winning? And now they are the country tailwind. The IT is growing not because Indians love IT or they are very good in IT, because the Americans and Europeans, the digital transformation the world economy is going through, that's the opportunity for Indian IT. Now, when you get this kind of tailwind in any sector, nothing can stop. It can become 50% of our total corporate profits. So you have to see which sector has the tailwind. जैसा भी आपका chemicals का हुआ, China plus है. China plus strategy, geopolitical, I don't have great view, but it looks the world wants alternative to China. They don't want to put, the world is going to become from 100 trillion to 200 trillion. Now that in next 100 trillion, they don't want 100% of manufacturing to come from China. They want their dependence to reduce. Now, which are the countries which can do it? The only country of the size which can actually give the labor pool of the size, shape, complexity is India. So India will have this problem. Now, how do we execute? See, opportunity आएगा. आपको जैसे स्टील प्लांट लगाने का opportunity आया था. वो लोग बोल रहे हैं हमको स्टील नहीं बनाने का, 200 मिलियन टन हमने कम करे. अरे भाई, तुम्हारे लिए ऑन अ प्लेटर दे आर गिविंग 200 मिलियन टन का मार्केट, बट यहाँ पर उड़ीसा में अभी भी एक भी प्लांट नहीं लग रहा है. भाई, जहां पर आपका आयरन हो रहा है, वो कंपनी वाले आके बोल रहे हैं हम पैसा लगा के लेके आएंगे, हम टेक्नोलॉजी लेके आएंगे, हम सब खुदाई सब करेंगे, लेकिन यहाँ वो फाइल तो आगे बढ़े. पूरा लास्ट बूम हुआ 2008 का, एक भी स्टील प्लांट नहीं लगा चाइना, इसमें क्या नाम है, उड़ीसा में. अभी फिर वापस आ रहा है. अभी देखिए आर्सेलर वो तो देसी हो गए, अभी मित्तल साहब हो गए, उन्होंने 25 मिलियन का सिंगल प्लांट 1 लाख करोड़ का किया, लेकिन उसका फाइल आगे बढ़ा नहीं बढ़ा मेरे नहीं मालूम. So every boom cycle में क्या होता है, entrepreneur brings investments, and now it's a global world, global capital. अभी कितना पैसा आ सकता है उसको कोई हिसाब नहीं. So all this manufacturing में जो capital flow आने का है, because when they see attractive destination in India, they come, but it gets stuck in Delhi or maybe state government, maybe some bureaucracy. That's where we should take opportunity. भैया आ रहा है, लाओ फटाफट 200 बोल रहे 400 मिलियन टन का कैपेसिटी एग्जीक्यूट करो, तो जाके 100 निकलेगा. So it is also matter of global tailwind for a sector, which nobody knows which way it is going to go. Second, then execution. Opportunity will knock India for sure. In IT, we executed that. We have to replicate that in textile. Textile may now knocking the door. We have the cotton, we have the technology, we have the people, we have the process. But can we execute? आप यहाँ फैक्ट्री लगाने जाओ, उसे पसीने आते हैं उसको. I mean, when you want to do a scale up, अभी लोग बोलते हैं मेरे पास 10 एकड़ जमीन है. अरे क्या होगा 10 एकड़ जमीन है तो यार. Now it has become a big talking point. I have got 10 acre extra land adjoining. So the land has become such a mess. Then how do you create a mega size, global size manufacturing without land? So execution is a big issue. And then freedom to the entrepreneurs. मतलब थोड़ा तो ट्रस्ट होना चाहिए. So ये सब चीज जब साथ में आएगा तब आपको मैन्युफैक्चरिंग मेगा 5 ट्रिलियन 10 ट्रिलियन फिर तो क्या स्काई इज द लिमिट यार. Indians can win. Indians have won everywhere wherever they've gone.
Sure. Prashant, given your global expertise and your background, I would want to understand from you today, when we see the top 100 companies worldwide, there are maybe 60 companies from US, 15 companies, I think 14 companies from China, and only 2 companies from India, which we know, which is Reliance Industries and TCS, if you make that list. Now, when we are saying that, India in this decade will add 2 more trillions, we will become a 5 trillion economy, we'll cross that. In that regards, do you see, more companies getting added to world order of world's top 100 companies?
Definitely, that would be the case. If I just look back, 20 years ago when I was working around this time, in early 2000s in the US, managing US portfolios, all my personal money was always 100% invested in Indian market, even though I was investing client money all in US. So वहाँ पे individual companies like Citibank's market cap was larger than India's market cap back in 2000 at the turn of the century. India का total market cap was $175 billion. Ramdev ji would agree and would recall as well. Okay, several individual companies in US, Cisco का nearly $500 billion market cap. Intel, hundreds of billions, nearly close to Cisco, and small companies which are now gone bankrupt, not there anymore, had market cap in hundreds of billions of dollars. Back then, I remember looking at the top companies in India. They were unka sorted by market cap. And by the way, I must incidentally, I remember Ramdev ji, I used to follow मोतीलाल ओसवाल का काफी अच्छा एक daily updated market commentary, and this market cap slide was also there. If you click through, you might have forgotten, but because I used to regularly read that, I remember. तो उसमें मोतीलाल ओसवाल would have all this listing of all the companies by market cap. There were 24 companies only which were above $1 billion. Only 24 companies or thereabouts across sectors. Right, and today if you see 150 plus companies are above or 200 plus, abhi to small cap is nearly $2 billion in India, right? And small caps are in more than 200. So I'm sorry, my 150 to 100 to large cap hai, then 150 mid cap. So probably 400 companies plus are over $1 billion in India. And that time when the entire country's market cap was smaller than several, maybe a dozen individual companies. And today, obviously, India's market is much larger than any single, including, Apple comes close. Only matter of time, you'll find more like TCS today is close to Accenture's size. Accenture being the largest IT services company globally, right? I don't remember, at some point it was larger than IBM. Unthinkable. IBM was like what Apple is today in terms of its stronghold over technology. IBM was 40 years ago or something like in US in the 80s, 70s, 80s, right? And today an Indian company is larger than that. So I think matter of time. I'm not saying India is going to conquer the list of 100. Still, you'll have it dominated by US, China, and Europe, but you'll see more and more names from India as well. To Ramdevji's point, it can accelerate tremendously if the Indian entrepreneur is given a more of a level playing field compared to its peers in US or China or Europe, right? So that is what is very badly needed. Over the last 5-7 years, there is a lot of progress made in this direction with the improving ease of doing business. But there's a long way to go. We are still 63rd in terms of ease of doing business. I always keep saying, hey, cricket, we can't tolerate being number 2. How can we tolerate being number 63rd when it comes to ease of doing business, which directly impacts our livelihoods, job creation, standard of living? So we have to make it a national target to become number 1 in ease of doing business. And when we do that, we'll have the list, every list dominated by Indians. And Indian companies.
Right. Thank you so much, Prashant. I think, it was quite insightful in terms of all the examples and all the data points that you shared. My next question to Ramdevji, is on macro. Though I know Prashant always says talking about macro is like an entertainment. So I'm not asking this question to Prashant. I'm asking this difficult.
Bigger entertainment here. Anyway, go ahead.
So, today, again, we are back to that macro fears of rising interest rates, rising inflation, and, it ultimately showing a possibility of fall in the markets. So in that context, what are your views? How do you see, these interests playing out? And then at the same time, we as an advisors tell investors that India as a country, as an economy is going through a different phase. We are seeing, a double engine kind of a government, though I don't say that, but we hear that, from government saying that, and we obviously see economic numbers visible. And that is where, there is a fight between, though macro being international and growth being maybe domestic. And that is where, we have maybe bears as well as bulls. What are your views in these regards in, say, 2022?
Yeah, so I think India would do well because one is that US has really overdone in terms of, now looking back, I'm not saying that what they did at that point of time was very clearly the need of the hour, and they saved the economy. Europe said that whatever it takes, and they also printed. Japan, China, I don't know whether they have stopped the press. So everybody just printed in a coordinated fashion, and it is unprecedented time. So you have printed unprecedented number of dollars or money all over the world. So the world is floating in. So if you look at the quantitative theory of money, there's too much of money, and there are few good, physical assets, whether it is a house, whether it is steel, whether it is cement. I think everything is just ballooning. So I think the problem of inflation, actually that 7.5% inflation of yesterday is really scary. Now this data point, because now this world is only about data. Forget about anybody's view. If yesterday it was like 0.5% lower, the market would have just gone through the roof. I'm telling you. But still there is a build-up because financial easing. Actually right now they're still pumping money while they're scared because the tapering is happening at a pace. So I think it has to go on till March, isn't it? So so we are still in February, so they're still printing money as per the plan. So inflation is still building up. So now his mandate is to bring down the inflation very quickly down, because otherwise once the bond markets, they understand that this is not transitory, this is permanent. It is not for 1 year, 6 months or something like that. It is like long term. We are into, you see today's chart. In 1980, it was 16% inflation. Then it came down vertically to 3-4% and then 1%, whatever. So that thing is looking like a complete takeoff. If you look at some stock chart, it looks like a 30 years, 40 years consolidation, and now it is coming out. And there is a reason for that to come out. So technically, if you ask some chartists, they might say it is headed for 18 only. So I think we are in a very scary situation. And all these guys, they are giving their own bit of it. And as you said, as it is said, it is a drama, talking about macro. So nobody has a clue whether inflation is good. Powell doesn't have a clue. He's saying that when the first inflation started raising the head, they said it is absolutely transitory. We are not bothered about it. Then he comes and says it is not that transitory. Now they are saying it is structural, and now they are scared. So day by day, in 3 months' time, he has talked so much. So I don't think anybody knows. and what needs to be done, because he has to douse the inflation. Otherwise, the whole thing will crumble. So my fear is this is the year of inflation fighting, and it will be fought. I don't know what all tools he will use. He has all the tools in the world to deflate the this thing. They have to kill some demand. You speak to anybody, they have 3 jobs. Every guy has 3 jobs at a better and better. And once the guy who is earning today $1 lakh, he goes to $2 lakh, that you cannot do anything. It's a permanent structural change in the cost structure of the economy. So, so I think they have to necessarily, other things are going out of hand. People are quitting Facebook, people are quitting Microsoft, people are quitting Walmart, and they are going to some startup. For what? From ESOP or something like that. One guy told me that he has quit this thing and gone to one startup. I said, how big is the startup? He says, our market cap is $15 billion. I said, did you ask how much is the sales? They strictly said, we don't talk the operations. And he's joining as senior guy. Can you believe this? So I think things have gone out of hand there. They have to douse it. But how fast and how severe it is going to be? My sense is the severity of dousing is going to be far higher than what he talks. He will talk softly, but act very firmly. So we should not see what he says. He is going to tell lies, I'm telling you. But he will act very firmly. Because data is saying that you got to act very quickly. The fire is out, you got to open the hose. Otherwise, it will burn the house. That's my feeling.
Right. Thank you so much, Ramdevji. Prashant, my question to you, again, what Ramdevji has mentioned with regards to, say, Fed announcements. Now, we know there is already an expectation that, say, in March, we will see a kind of a 0.25%, rise in interest rates. And as per Ramdev, if I take cue from Ramdevji, it will be, say, 50 basis points and not maybe 25 basis points. And then maybe, going ahead, it could be higher. And then in that context, what are your views with regards to these macro risks? Though I know, it is an entertainment for you, but still, out here, because you two are thought leaders and investors kind of, want to definitely ask this question in 2022. What are your views in this regards?
Certainly, just trying to keep short as well. I think Ramdevji covered it very well, that nobody knows, right? There's a certain expectation of inflation and Fed hikes that is being built already in the near term and long term rates. So the 10-year has risen to 2%. The 30-year has risen up as well, but to lesser extent. So if the surprise is going forward, the realized numbers are much higher and much stickier for longer, then there might be further upside to these inflation expectations and interest rates. But if it is more or less in line, then we might be, where the interest rates would be. And if it comes somewhat below, let's say it's not as scary, a year, 2 years down the line, it turns out that indeed it was an inflation spike in great part due to supply chain disruptions because of COVID. We all know supply chains have gone haywire because of inflation, because still China is following a zero COVID policy. So the amount of time it takes to clear a ship from the port is much longer than it used to be. And once the supply chain is broken, it takes a little while to fall back in place. And inventory has been run down. So the consumption of a lot of things like electricity consumption hasn't really gone down too much during the pandemic and COVID and all that, right? But the coal production did take a hit during that time. So the inventory got run down during that time. Now coal production may come back online, but to rebuild the inventory is going to take some time. So in that interim process, time period, there could be greater inflationary pressures that might subside later. It is very, very difficult to say all these things. There have been time periods in the past where rising interest rates have been accompanied with very strong equity market returns, like 2004 to 2007 was the last such time period where Fed increased rates and equity markets gave fantastic returns. So very important, what happens to long-term inflation expectations, whether they turn out stickier, what happens to long-term rates, and in that environment, what are the expectations for growth? Because if growth expectations also get elevated, then markets might do just fine. If growth expectations take a hit and inflation expectations start mounting in a sustainable, sticky manner, then certainly all asset classes would take a hit because the discount rate would go higher without the commensurate increase in long-term cash flow expectations. It's very difficult. These are, various environments. You may have next year on this forum, we might be sitting and inflation expectations are back down, and the 10-year bond rate is back down or hovering right around where it is, because this whole inflation does turn out to come eventually in control if it indeed is because of supply chain disruptions.
I wish so in 2023. And on that note, I would like to say thank you to both Prashant and Ramdev ji for sparing their time. Thank you very much. Over to you.
Thank you, Kamal.